Hey everyone, welcome back. Ready for another deep dive?
Always ready to explore something new.
Well, today we're tackling a topic that one of you specifically requested, moving average crossovers for swing trading.
Oh, yeah, those are always popular.
Definitely popular. And yet, we all want to find that best crossover, that magic formula.
The Holy Grail.
Exactly. But as we dive into this research, we're going to see that it's not that straightforward. There's no one-size-fits-all, but there are some seriously powerful insights waiting for us.
That's what makes it so interesting.
I know, right? So let's talk about these moving averages. Why are they such a big deal in swing trading?
Well, think about it. The market is noisy, right? Prices bouncing up and down all the time.
Oh, tell me about it. It can be hard to see the forest for the trees sometimes.
Exactly. And that's where moving averages come in. They help smooth out all that noise so you can actually see the underlying trend.
Makes sense. Sort of like taking a step back to get a clearer view.
Precisely. Now, you've probably heard of the classic 50-day and 200-day moving average crossover, right?
Oh, yeah, that's one of the first things you learn about, isn't it?
It is. And for good reason. It's a really useful tool for identifying those longer-term trends.
So remind me, what exactly are we looking for with this crossover?
Well, when the shorter term, that's the 50-day moving average, crosses above the longer term, the 200-day.
Ah, that's the golden cross, right?
You got it. It's often seen as a bullish signal, suggesting that the price is likely to trend upwards.
And I'm guessing the opposite. When the 50-day dips below the 200-day, that's bearish.
Exactly. That's the dreaded death cross, a potential downtrend ahead.
Okay, so those crosses can be pretty helpful indicators, but it sounds like I shouldn't base all my trading decisions on just those, right?
You are catching on quick. While those signals can be valuable, they shouldn't be your only tool. It's super important to remember that they're lagging indicators.
Lagging, what does that mean?
It means they are reacting to past price movements. They tell you what has already happened, not necessarily what's going to happen next.
Oh, I see. So they're like looking in the rearview mirror. Not always the best for navigating the road ahead.
That's a great analogy. And in fast-moving markets, that lag can be really significant. You could miss out on opportunities or even,
End up on the wrong side of a trade.
unfortunately, yeah. So how can we make these crossovers more responsive? Especially for swing trading, where we're looking for those shorter-term swings.
Right, because if we're waiting for the 50 and 200-day to cross, we might miss the boat completely.
Exactly. So one way to make them more responsive is to use shorter-term moving averages.
Ah, so instead of 50 and 200-day, what, like a 10 and 20-day?
You got it. Those will react much faster to price changes, giving you more timely signals.
I can see how that would be helpful, but wouldn't that also increase the chances of getting those fake-out signals, those false signals?
Yeah, that is definitely a trade-off. Shorter-term crossovers can be more sensitive to those little wiggles in the market, which might not actually mean anything in the long run.
So it's a balancing act then, isn't it? Finding that sweet spot.
Absolutely. And there's no one right answer. It really depends on you, your risk tolerance, your trading style. Some people thrive on the fast-paced action. Others prefer a more laid-back approach.
So you're saying there's no magic number, no perfect moving average combination that works for everyone.
It's all about finding what works best for you, and a big part of that is experimenting. Try out different combinations.
Right, backtesting. See how those different combinations would have performed historically.
Exactly. Put them to the test. And don't forget, you don't have to rely solely on moving average crossovers. Combine them with other indicators.
That's right, we talked about that earlier. Can you give me an example? How would you use another indicator alongside a crossover?
Okay, let's say you're seeing a potential buy signal based on, maybe your 10 and 20-day crossovers. But you want to be extra sure. You could look for increasing trading volume, more people jumping in, or maybe a breakout above a resistance level.
So kind of like confirmation from other sources. It's not just the moving averages saying buy, but other things too.
Exactly. Multiple indicators all pointing in the same direction. Increases your confidence, right?
Definitely. Makes a lot of sense. Now, I also want to touch on something else. We've been talking a lot about the technical side of things, charts, indicators. But what about the fundamentals? Where do they fit into all of this?
Ah, good point. We can't forget about the fundamentals. Remember, technical analysis is all about studying price patterns, while fundamental analysis is about the company itself.
Right, like their financial health, their industry, all that good stuff.
You got it. And combining those two approaches can give you a much more well-rounded view of the market.
So it's not just about chasing lines on a chart, but also understanding the story behind those lines.
That's a great way to put it, because sometimes the story doesn't match up with the picture.
What do you mean?
Well, let's say you're looking at a stock and you see that beautiful golden cross forming, but then you dig into the fundamentals and realize the company is actually struggling.
So the technicals are saying buy, but the fundamentals are screaming run away.
Exactly. It's a reality check. The fundamentals can tell you whether that technical signal is actually reliable or not.
That's a powerful insight. So for our listener who's deep diving into moving average crossovers for swing trading, what's the key takeaway they should walk away with?
I'd say the most important thing to remember is that moving averages, as powerful as they can be, are just tools.
Tools that need to be used wisely.
Absolutely. Understand their limitations, experiment, and most importantly, combine them with other forms of analysis. Don't just rely on one thing.
Great advice. And here's a final thought for everyone to ponder. If everyone could consistently profit using only technical indicators.
Wouldn't everyone be rich?
Right. The market wouldn't be much of a market, would it? It's that combination of technical mastery and a deep understanding of what's driving the market that gives you a real edge.
Couldn't agree more.
All right, everyone, that's a wrap for this deep dive. We hope you found this exploration into moving average crossovers helpful. Keep those requests coming, and we'll see you next time.
See you then.